Welcome back, students who are taking financial accounting, and in this series of videos we are continuing on with working on the assigned homework problems from the digital study guide for chapter 3, the short exercises. And we stopped on 3-3 in the last video, so this will be 3-4, and we'll see how far we go. Adjusting journal entry, prepaid rent. All right, Julie's Flower Shop prepaid rent balance is $4,500 on July 1st. So on July 1st, the prepaid rent is $4,500. This prepaid rent represents 6 months of rent. And so July, August, September, October, November, December, January. So this is 6 months all the way to January of the next year. Okay, so that's 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. 6 months. Notice that I'm drawing a timeline here. This is to help me visualize what's going on with a particular problem. Okay. Sometimes I do this as a tool to help me, clarify in my mind and visualize what is actually being asked here. And so Julie's Flower Shop prepaid rent balance is $4,500 on July 1st. This prepaid rent represents 6 months. Journalize and post the adjusting entry on July 31st to record 1 month's rent. Compute the balances of the 2 accounts involved on July 31st. All right, so we're going to compute the balances. And so we're going to call this prepaid rent. And it has a debit balance of $4,500. Come on, pens. Let me erase that a little bit. So on 7/1, it has a balance of $4,500. Okay. Now, when I make the adjusting entry, obviously, for the whole month of, July, I'm using 1 month of that rent. So the opposite side of that entry is going to be rent expense. And this, notice what I just did. I just thought about problem 3-3, in that I didn't think about whether this was an accrual or whether this was a deferral. Okay, I just know that when I have a prepaid rent and I use it up, that means I'm expensing, the rent. Right? I don't have to think about accrual, deferral. I just know the opposite side of the entry is going to be rent expense. So if I have $4,500 and that represents 6 months of rent, I'm going to divide 4,500 by 6, and that's going to give me $750 is each month's rent per month. Okay, so when I go to do this, now I know that if I'm thinking from the perspective of a journal entry, okay, am I affecting cash? No. Am I affecting accounts receivable or payable? No. Use an account that I already know. Well, if I know that prepaid rent, the normal balance of the prepaid rent account is a debit, right? And I'm going to reduce it. That means I'm going to credit prepaid rent by $750. Well, if I credit something, I have to debit something else. So what am I debiting? Well, I know I'm debiting the rent expense. Notice that I'm backing into it and I don't have to think about whether that's a debit or a credit. So this is going to be my journal entry. Okay, and when I take that journal entry and I post it to the accounts, I'm going to post a credit to prepaid rent. That's on 7/31, and 7/31 I'm going to debit the rent expense for $750. So the balance in the prepaid rent account is going to be $3,750, and the balance in the rent expense account is going to be $750. Okay, And so that's how I'm expensing, that prepaid rent for this particular problem. All right. So it says compute the balances of two accounts. There's one balance, there's the other balance. And here's my journal entry that I need to make. All right. Next problem. Julie's Flower Shop office supplies balance on October 1st is $1,200. Right, so office supplies balance on October 1st is $1,200, and the balance in office supplies expense is $0. On October 31st, so let's create a couple of T accounts here. So I have office supplies, and on October 1st, that balance is $1,200. And so office supplies expense, the balance is $0 on October 1st. On October 31st, there is $480 of supply on hand. Journalize and post the adjusting entry on October 31st for the supplies used. Compute the balances of the two accounts involved. Okay, so if my office supplies started out with $1,200 at the beginning of the month, and at the end of the month I have only $480 on hand, that means I've used $720 worth of supplies. Okay, and so that means I have to adjust my office supplies down to the 480. Well, if I know that I have a debit of 1,200, and I'm reducing it, that means I'm going to credit, office supplies for the 720, and because I have a credit, I have to debit something else, and I know I'm debiting office supplies expense for 720. So that's going to be my journal entry. Right? And when I go to post it, right, I'm going to post the credit for 720 as of 10/31, and I'm going to post the debit for 720 as of 10/31. So when I create the balance in the account, my balance in the account as of 10/31 is going to be 480, and the office supply for 10/31 is going to be 720. Right? And so that's the, those are the balances in those two accounts after I make the adjustments. All right. Next problem. Interest expense. Okay, so notice what we're doing with these problems. We're taking specific situations and we're working through an example. And for the most part, you can mimic these the math, the thinking through it. Okay, don't automatically assume that you could just copy it exactly and just replace numbers. Okay, because it doesn't always necessarily work that way. But for the most part, this is the thought process going about. Up here where we're making an adjusting entry to prepaid rent. Well, this is how we make, our thinking through making an adjusting entry for prepaids. This one here is, making an adjustment for any of our inventory type accounts, supplies, merchandise inventory, office supplies, whatever it ends up being, that we're inventorying, and we have to do a physical inventory for and then adjust accordingly. For 3-6, it says, in order to purchase equipment and supplies, Sinclair Bike Shop borrowed $28,000 on August 1st by signing a note payable to Community One Bank. Right. Interest expense for the Sinclair Bike Shop is $140 per month. Journalize an adjusting entry to accrue interest expense at December 31st, assuming no other adjusting entries have been made for the year. Post the two accounts affected by the adjustment. Okay. All right, so we have, let's see here. timeline on August 1st, we're borrowing $28,000. Okay, and when we borrow that $28,000, we're signing a note payable, right, to Community One Bank. So that entry on August 1st would have been we're receiving cash, so our we're affecting cash, so we're going to debit cash for the $28,000, and we're going to credit notes payable for the $28,000. Okay. So interest expense for Sinclair's Bike Shop Inc. is $140 per month, right? And if it's $140 per month, and we're going all the way to December 31st, so that's all of August, September 1, October 1, November 1, December 1. Okay, so all of August is 1, all of October is 2, November is 3, October is 3, November is 4, and December is 5. So that's 5 months. Okay, and since it's $140 a month times 5 months, that gives us $700, all right, of interest that we are accruing. All right, remember, we're borrowing here, so we're accruing that interest expense. We haven't paid it. We're not paying it until we get to December 31st. So assuming no other adjusting entries have been made that year, post to the two accounts affected by the adjustment. So what we're looking at here is we're saying, okay, we have interest expense, right, which had as of August 1st, had a zero balance in it. Okay, and we're accruing it over time, so that means we're going to owe it. So this is going to be interest payable, and as of August 1st, the balance in our interest payable account is zero also. Right? So now we've calculated that we have $700 worth of interest that has been accrued over that course of that time. So does this affect, is this entry going to affect cash? No. Is it going to affect accounts receivable or payable? No. But, use an account that we, understand the most. So interest expense is, I know that I'm going to I'm accruing an interest expense, and the normal balance of an interest expense account is a debit. So I'm increasing my interest expense on the debit side, so I have interest expense for $700, and then I just have to credit something else, and that happens to be interest payable for $700. Okay, and so that's my journal entry that I'm going to make. And of course, when I enter it in, I'm going to enter it on 12/31 for $700, and 12/31 for $700, and that means the balance in my interest expense account is going to be $700 as of 12/31, and it's going to be a credit for interest payable for $700 on 12/31. Okay. So with that problem, as you can see, right, even though I thought about this 28,000 and I had shown making the entry because it was we had borrowed it on the 1st of August, that had nothing to do with solving this problem, because what was being asked was the adjusting entry that needs to be made. We didn't pay down anything on this this note payable. Okay, all we're doing is we're figuring out how much interest has accumulated or accrued during that period of time, and we had to figure out that period of time being 5 months at $140 a month. All right. So during that time, we're accruing this interest at $140 for each and every month. When we got to the end, we have $700. Now, no entry was made, so we have to make an entry for it at the end of the year. And when I showed making the entry as a debit to interest expense and a credit to interest payable. Why? Because we still owe the interest payable just like we still owe the note payable. Okay. So with that, if you have any questions, feel free to, watch the video again or watch that particular exercise again. And if you still don't understand, go ahead and contact an instructor, but I will pick up with 3-7 in the next video.